Good evening and a very warm welcome to First Issues. Credit rating agencies have come under quite a bit of criticism since the credit crisis began in 2007. This is because a lot of the mortgage-backed securities that they had given the best possible rating turned out to be virtually worthless and triggered the worst financial crisis in decades. The United States Securities and Exchange Commission, or SEC, is said to be tightening up on the way they behave. One of the moves would stop individuals on the sales and marketing teams from participating in the actual ratings. The EU is reportedly not happy either. According to BBC News, the potential for a downgrade to destabilize a country was so feared that the European Parliament in 2014 agreed to a set of rules designed to rein them in. They state that agencies can issue ratings on countries no more than 3 times a year, and only after markets have closed. Europe also wants to dilute the power of the big 3 rating agencies, that is Standard & Poor's, Moody's and Fitch, by encouraging financial firms and others to do their own credit assessments. These measures indicate an acknowledgement of the power and impact that ratings have had on markets and the wider economy. Neighboring South Africa has also taken issue with being relegated to junk status in the past. President Jacob Zuma has bashed credit rating agencies over what he says are inconsistencies and Western bias in the way the main credit rating agencies operate. He and the leaders of the BRICS Association of Countries, that is Brazil, Russia, India, China and South Africa, announced in 2016 that they felt it necessary to establish their own agency, partly because of the way that rating agencies had behaved in developing countries had left them with some concerns. Tonight we take a look at how these ratings agencies formulate their ratings, as well as contemplate what weight their assessments still carry. We ask the Managing Director of eConsult and former Deputy Governor of Bank of Botswana, Dr. Keith Jeffries, what the implications of these ratings given by these agencies are for the countries or companies that are graded.
What the rating agencies do is they apply a rating to several different things. They can apply a rating to a bond, a specific bond, which is a debt instrument. So it's a way of borrowing. And bonds are issued by countries, those are sovereign bonds, or they may be issued by companies or other issuers or banks, for instance. And then they will also apply a general rating to an issuer. And an issuer can be a company or a country. So you get issuer ratings and then specific bond ratings which will apply to different bonds. And what the credit rating refers to is the probability that there'll be a default on the bond. So obviously if you buy a bond from an issuer, you're essentially lending them money. What's the probability that you might not get your money back? Or you might not get the interest payment. So essentially it's a default risk. And the different agencies have different scales, but at the top would be, say, AAA, AAA. And that would be applied in the case where the probability of default is said to be virtually 0. And then it goes all the way down through AA, B, C, D, and D would be default. C would be close to default. B is a sort of medium risk, A is B is a medium risk, and A would be low risk of different degrees. And then somewhere in the middle, it depends a bit on which agency you're talking about, because they all have slightly different scales. There's an important dividing line between investment grade and junk. And so investment grade ones are sort of in the top half of the scale and junk are in the bottom half of the scale. So the agencies essentially, as I say, apply ratings on their scale from top to bottom, which quantify the risk of repayment or lack of repayment of the bonds. And then for issuers, it's a bit more general as to whether the quality of the issuer and their financial capacity.
What kind of things do they look at to evaluate a country or an issuer's ability to repay?
Well, it'll look at obviously all bonds are repaid out of income that is earned somehow. So if it's a company that's an issuer, the rating agency will look at the types of business they have, where they get their revenue from, whether they're profitable, what the projections are, because of course all these bonds can be quite long term. Some bond issues can go out to 20, 30 years or even longer. So it's all very speculative because it's about forecasting future ability to repay. It's not just ability to repay now. It's, will a company or a country have the ability to repay a bond which is due maybe in 25 years' time, and will they be able to pay the interest over that period? So they're essentially doing forecasts of the financial capacity of the issuer and looking at what are the risks around those forecasts. So there may be say if you take a company, there may be a forecast of its profitability, but it being a forecast, it's uncertain. So how much uncertainty is there? What's the risk, what's the probability that a company may end up in financial trouble and hence being unable to repay the bond? And the same would apply to a country. But if it's a country, it'll be looking more at macroeconomic factors, like where does the government get its tax revenues from, what's its budget situation, does it have a budget deficit, surplus, does it have money in the bank, etc., etc. So it looks at all aspects of financial strength, and as I say, it's all about forecasts. So what are the uncertainties around those forecasts?
Do stay with us. Our conversation with Keith continues after the break.
What is the future of help? It's to help people find the great in themselves. The drive, the passion. Help them find their true potential. Help them stretch. Help them grow. That's why we help people help themselves, help the world, because a little help goes a long, long way. FNB, how can we help you?
Welcome back to First Issues as we continue our exploration of credit rating agencies. As a seasoned economist, how confident are you in these types of ratings? How confident are you about their accuracy and their dependability, seeing that major mistakes have been made in the past?
Well, I think it varies. So for countries, I think the ratings are quite good. In the sense that, countries are in many ways predictable. You know what economies look like, you know what future trends are likely to be, or at least you can estimate future trends. So I think the estimates of whether a country is likely to be able to repay its bonds and service its bonds are quite reliable. And obviously you've got a sort of track record of, has a country managed to service its bonds in the past? Has it ever defaulted? So, you take somewhere like Argentina, which has a very low credit rating. Well, that's justified because in the past they've defaulted on bonds. If you look at the United States, it's got a very high credit rating, although not the highest because it's got political problems with Congress. They have battles over approval of borrowing limits. The UK was downgraded because of all the business around Brexit, so it's less reliable now than it once was. Someone like Germany would have a very high credit rating, so it's got very strong public finances. With companies, it's a bit more difficult, but even I think with large companies in conventional businesses issuing conventional bonds, it's okay. Where the problems come and where the problems arose back at the time of the global financial crisis was with new types of securities. So these mortgage-backed securities, well, mortgage-backed securities as a class of asset have been around for a long time, but in the run-up to the financial crisis, banks were issuing all types of new securities, and these were new in the sense that they were carving up different revenue flows with different types of collateral behind them. Because that's another thing about bonds, is normally they have collateral, so that if there's a default, there'll be something there to pay off the debt. Now, what's the quality of that collateral? And so in the run-up to the global financial crisis, banks were issuing all sorts of new types and exotic types of securities which had not really been tested in stressful situations. So I think the rating agencies, firstly, were rating instruments they weren't very familiar with, and secondly, I think they were not critical enough of the claims that were being made by the issuers, by the banks. And I think the criticism was justified that they were giving vastly overhyped ratings to these new types of securities. But as I say, with sort of more conventional and predictable types of securities, I think their ratings are more reliable.
We witnessed the United States, after being downgraded, still have investor confidence. Lenders still still trusted its ability to repay. What does this say about the weight that these grades now carry internationally, do you think?
The grades have an important weight, but clearly investors form their own views as well. I mean, whether the US gets downgraded from AAA to AA, it's not a big move. It still means the risk of default is very low. And the risk of default from the US government, it's not because it can't repay. I mean, particularly when a country issues bonds in its own currency, then really, because a government can create money, the chances of default are quite low. The problem in the case of the US was not because it couldn't create money to repay the bonds, it's because it didn't have the legal authority to issue debt beyond a certain limit because of the limits imposed in law by Congress. And so the risks with the US are not that it didn't have the power to repay these bonds economically, it was a legal and political problem. And so, investors will form their own judgment. I mean, if you're buying American government bonds, what do you think the chances are that the US government will default? Probably not very high, because at the last minute they find a way around these debt ceilings, which Congress has to approve when they're changed. So, investors form their own views, particularly when the issuer is a very well-known entity. And I'd say there's no law about having to be guided by credit ratings. That is the case, but some issuers are only able, either by law or by regulation, to, for instance, buy investment-grade bonds. And this is why the issue, say, in South Africa, South Africa has investment-grade bonds issued by the South African government, but there's always fear that they're going to be downgraded. In fact, I think they have an investment-grade rating from some agencies, but not all of them. And so what happens then is that if an issuer gets downgraded, some buyers, say for instance pension funds, are not allowed to buy junk grade bonds. So if an issuer gets downgraded from investment grade to junk grade, they may find people selling off the bonds, which is obviously a problem because it means it's then going to be more expensive for them to borrow money in future.
More recently, we saw China formulate its first US dollar sovereign bond since 2004 and choose not to use international rating agencies for this particular bond. What does this say to you, and what do you think will be the implications of that move? What are the implications of simply sidestepping?
The implication is if you can still find buyers for your bonds, then all well and good. And I mean, I don't know the details of this Chinese issue, how big it was, for instance, but if they can still find buyers, and they will presumably have been looking for buyers who are not legally required to invest only in bonds which have a rating from one of the big three agencies. So that's sometimes the case, that some buyers can only buy bonds that have been rated. But you might find, I mean, let's say, for instance, some central banks, I mean, just to speculate, there may be some central banks which are able to buy bonds which have not been rated. I don't want to name any names. It doesn't include Bank of Botswana, but there are some central banks who are big holders of bonds who might not be restricted. And therefore they could buy, if they would form their own judgment about the quality of Chinese government bonds, and if they're not rated, well, they still go ahead.
Overall, Dr. Jeffrey says the function that these agencies perform is invaluable to the industry, and therefore they cannot be supplanted. Do stay tuned. Up next is another issue of interest.
What is the future of help? It's to help people find the great in themselves. The drive, the passion. Help them find their true potential. Help them stretch. Help them grow. That's why we help people help themselves, help the world. Because a little help goes a long, long way. FNB, how can we help you?
Welcome back to First Issues. The image of Hurricanes Harvey, Irma, Maria, and Jose battering their way across the Americas and the Caribbean has probably been burned into our collective conscience and is likely to be one of the more memorable moments of 2017. Hurricane Harvey's deadly cocktail of wind and moisture in particular hit America's fourth largest city with a ferocity that Texas had never seen. While scientists maintain that no single weather event can be attributed to climate change, the National Geographic news site says that 2 centuries of human fossil fuel burning has altered temperatures just enough to almost certainly make this particular storm worse. The Los Angeles Times reports that weather-related disasters have tripled since the 1980s, and annual average insurance losses have increased from $10 billion to about $50 billion over the last decade. Insurers are rightfully worried that in the long term, climate change could devastate their industry. European insurance titans, the likes of Lloyd's, Swiss Re, and Munich Re, are said to be heavily investing in research to more precisely predict the toll that climate change will have. American firms are also said to be incorporating warming temperatures into their business models, according to industry surveys. Some insurance firms are even devising schemes to encourage individuals, cities, and even countries to get their heads out of the sand, like offering cheaper rates to policyholders who use solar panels, build higher and safer structures, or reduce carbon emissions. Raising the alarm locally was the Principal Safety, Health and Environment Policy and Sustainability Advisor from Sasol, Shamini Harrington, at the recent Insurance Institute of Botswana's first annual conference. She tells us what all stakeholders need to truly appreciate about this changing state of affairs.
Climate change is about that variability in the climate. It's about those changes into the future. And it's about this sector getting a handle on how you understand the future better. Because my understanding is the insurance sector looks at the past and past models to evaluate risk, to underwrite for the future. And in this scenario, where climate change is going to exacerbate things that are happening today, how do you use the past to evaluate something that's changing into the future, that's changing today? So it's important that they get a handle on understanding what the climate projections are for a particular area where you are located. So in this instance, for Botswana, how do you start evaluating risk, flooding, drought, desertification, those kinds of issues into the future by overlaying these climate change projections? And that's what's important. It's about getting a handle on the science. So the science is not for the scientists only. There are issues, there are risks, there are opportunities that need to be honed in from the science that the insurance sector can look at and needs to start looking at. So it's not just about them understanding their little world, it's about bringing a little bit of my world into it.
I can't help but ask, as a representative of Sasol, or as an employee of Sasol, an oil company, how does climate change affect your day-to-day business? What is the future looking like for this fossil fuel company?
So Sasol has taken great strides over the years, and we've made massive changes in our business model because of climate change. All the way back in 2004, we brought in gas. We were the first company to bring gas into the country. South Africa does not have gas. It has lots of coal, similar to Botswana, in fact. And Sasol saw the need and brought gas in, and we were able to reduce our emissions substantially. In fact, we've beneficiated that gas to the point where we've provided it to our consumers and have changed their business model and their energy feedstock. We are exploring further for more gas. We have stopped investing in coal in that way. We are looking at maintaining existing operations but doing it better. How can we use coal better? We are not looking to grow on coal. So we've taken strategic decisions already for the company in light of sustainability issues generally, because it's not just climate change. If you stop using coal, you also change the air quality situation in the areas where you operate. So these are all important considerations. We've also improved our energy efficiency by more than 17%, and at this point I think we're sitting at about 22%. That's more than most companies globally even. So we're taking great strides and exploring and investing money in trying to find more gas to bring that in as a transition fuel for the company.